As a new Forex trader, it's important to know some basic definitions both to understand the currency markets and to help define your strategy. This brief video describes what a currency pair is, who the Forex market participants are, why the Forex market is an OTC or over-the-counter market, and what liquidity means there. When you trade Forex, you trade one currency for another. Forex markets enable you to trade any two currencies in the world. The currency pairs traded most often are called the major currency pairs. Other currency pairs are called minor or emerging currency pairs. When you and your fellow Forex traders buy and sell currencies, you create opportunities for other Forex traders to sell and buy. Forex traders include individual traders as well as companies, financial institutions such as pension funds, hedge funds and brokers, and banks. The motivations of the market participants vary. Individual traders trade for profit. Manufacturing companies may wish to protect physical investments by hedging. Financial institutions may also hedge or simply invest. And central banks may wish to affect prices and trade volume. For example, if a national bank wants to weaken its currency so the country remains competitive for exporting goods and services, it may buy foreign currencies against its own currency. Foreign exchange transactions are not performed on any central exchange, but are conducted mainly bilaterally between market participants over the counter, OTC. These Forex transactions are facilitated mainly through trading platforms, enabling buyers and sellers to see real-time bids and offers for multiple currency pairs. The ease of transacting something at the desired price and volume when you want to is called liquidity. Some currency pairs are traded a lot and are said to have good liquidity because any given trade does not really affect the price. Other currency pairs are traded less and typically have less liquidity. Several factors affect liquidity, but fundamentally it's about traders being able to buy or sell what they want, when they want to, and at what price. This comes down to pricing and volume. Other factors such as geopolitical events, economic news, and certain participants can also affect volume or pricing and thus liquidity. As an example of how an event might affect liquidity, if laws are passed that are thought detrimental to a country's international trade, Forex traders might sell the currency. This may result in a very high liquidity market with a high volume of trades, but it could also trigger a low liquidity situation if participants are reluctant to buy the currency expecting further decline. We will revisit liquidity in a different video when we talk about pricing. This concludes the overview of currency pairs, market participants, and the concepts of over-the-counter market and liquidity.